All right, we are live. Good afternoon, everybody. Hope everyone's doing well. This is Jeremiah Conjure tuning in from Annuity Association, and today we are going to be conducting another, you guessed it, unbiased annuity review. Today we're going to be discussing the F&G GPowerAccumulator fixed indexed annuity. So if you're in the market for safe accumulation, safe growth, and you're not finding it in your traditional safe money instruments such as bank certificates of deposit, money market accounts, or even bonds, fixed indexed annuities are a very suitable alternative to help someone approaching retirement, or maybe you've recently retired and you're looking for safe yield. Fixed indexed annuities are a very suitable alternative to help you accomplish just that. The Power Accumulator that we're going to be reviewing today is a pure accumulation focused fixed indexed annuity. So its primary intended purpose is to grow assets safely with no market downside risk. And it's going to do that using some unique index crediting strategies. Now, in our review, if this is the first time you're tuning in, we're going to be covering the features and benefits located in the product brochure and really diving into those and making sure we uncover all of the features and benefits, pros and cons, if you will, and helping you understand the product more in depth. And then later on in the review, we're going to be taking a look at our software, where we'll take a look at this individual product, the Power Accumulator from F&G, and we will take it through what we call our backtesting exercise, where we'll take the index crediting strategies that are associated with this particular product and backtest them over the last 10, 15, and 20-year periods to see how they would have performed hypothetically if we would have owned that product during that time frame. So it's going to give us an idea of what we could possibly expect from a future growth performance. But of course, with anything looking backwards, prior performance is not always an indicator of future performance. So just keep that in mind. Before we get started, I'm going to go ahead and dive into our handy dandy brochure, and then we will get started with the, our handy dandy disclaimer, and then we'll get started with the brochure. So bear with me. I'm going to go ahead and share my screen. And I do apologize if my voice sounds a little off. I guess my daughter passed on a little cold to me, so I'm battling that, but all good other than a little bit of a raspy voice and some congestion. Okay, so we're talking about the F&G Power Accumulator. This is a fixed indexed annuity, and of course, an unbiased independent review brought to you by AnnuityAssociation.com. This is a review, not a recommendation to buy or sell an annuity. F&G has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness and or accuracy. Okay, so we've gotten that out of the way. Before we dive into the brochure, if you're like me, you're in the market for annuities, and if you're like me, you're one of the consumers that likes to do their research before they invest any of their monies or hard-earned savings into a product, whether it be a consumer good or a retirement vehicle like an annuity. So our mission here at Annuity Association is to help you make an educated decision on whether or not an annuity is right for you. And if so, help you narrow down of the 4 or 5 different types of annuities, which specific product or products are going to help you meet your needs, goals, and objectives for retirement. And if you'd like to work with me directly, I work with clients in all 50 states. I'd be honored to have the opportunity and privilege to work with you. You can visit our website at AnnuityAssociation.com. Right there on the main page, click the green button to request your free report. There you'll be taken to a series of opt-in questions where one of those will ask if you'd like to be contacted by an advisor. Simply answer yes, and I will personally reach out to you in a timely fashion to see when we can get together to see if I can help point you in the right direction. So without further ado, let's go ahead and pull up the product brochure. So I'm going to go ahead and share my screen again. and we will dive right in. So again, we're talking about the F&G, which is also known as Fidelity and Guarantee Power Accumulator 10. This is a fixed indexed annuity. And the Power Accumulator 10 helps you preserve your savings with index growth potential and no downside market risk. It also assists with helping you meet your expenses with access for qualifying health conditions and limited partial withdrawals. And in addition to that, last but not least, to help leave a financial legacy with a death benefit for peace of mind. So who is F&G? Since 1959, Fidelity and Guarantee, or F&G, has been the silent, unseen enabler of the hopes and dreams of millions of Americans. Today, F&G provides annuities and life insurance for over 700,000 people across the United States, and the people who hold their policies were introduced to them by someone they know, their financial or insurance professional. With F&G, you collaborate with them to be partners in prosperity with you and the people you care about most. Working together, we become something greater. We become agents of possibility, agents of empowerment, agents of stability and security in a volatile world. We work together, think together, succeed together, and collaborate to help you prosper. It's a great message from F&G. They are very customer-centric, as I've said in a previous review of another one of their indexed annuity products. They really do treat their customers, with the red carpet experience, and really think highly of this company in regards to, investing a portion of your retirement nest egg. I feel confident that F&G can help you meet your needs above and beyond. So, what is an annuity? An annuity is a long-term retirement tool that can be a cornerstone of your financial security and success. You pay a premium, think of it as your principal, to F&G, and F&G provides an annuity contract with unique benefits to you. An annuity protects and potentially builds your savings with the option of converting them into scheduled income payments for retirement. If you're interested in an opportunity to grow your savings, benchmark to a market and exchange traded fund index without the risk of actually participating in the market, this fixed indexed annuity may be a good choice for you. This quick reference guide is intended to provide a helpful overview of the F&G Power Accumulator 10. It is coupled with the Statement of Understanding, which will be referred moving forward as the SOU, and that explains this annuity in detail. The SOU contains product information that is important and specific to you to give you an understanding of this annuity. If you decide to complete an application, your financial or insurance professional will ask you to sign an acknowledgement to confirm you've received and read the SOU. In the event of any conflict between this guide and the SOU prevails. Your financial or insurance professional is able to explain the benefits and restrictions that apply in your specific state. Read on to learn more. So what are exchange-traded funds? Exchange-traded funds trade like stocks but can track and index like the S&P 500. They can hold a basket of assets, stocks or bonds, in a sector such as a commodity or area of the market. They combine some of the features of stocks and mutual funds, the liquidity of stocks, and diverse holdings of mutual funds. You can benchmark the growth potential of your savings to any or all of the ETFs that are offered. Your savings are never directly invested in the ETFs themselves. BlackRock provides experienced management. So one of the index crediting strategies found in the F&G Power Accumulator is the BlackRock iShares Index, and we'll be discussing that here momentarily. But BlackRock draws on the knowledge of its investment teams in 30 countries to professionally manage the largest investment fund in the world. It is the world's largest provider of ETFs, managing over $6.5 trillion of assets as of the first quarter of 2019. You can tailor your choice to your own preferences. If you have an interest in a particular area of the market, you may accommodate it. With the benefit of diversification in that sector, ask your professional today about the potential interest earnings options F&G benchmarks to ETFs from iShares by BlackRock. So is the F&G Power Accumulator 10 a good option for you? Well, that's exactly why we're conducting this unbiased annuity review today. We're going to be discussing the features and benefits and also taking a look back using our backtesting exercise to see how this specific index crediting strategies offered in the Power Accumulator 10 by F&G would have hypothetically performed if we owned the product over the last 10, 15, and 20 years. So stay tuned. We'll be getting into that momentarily. And then last but not least, we'll also be taking a look at a sample illustration to show you the mechanics of this annuity and how it would look on a ledger. So the F&G Power Accumulator 10 protects your savings from market risk while potentially giving you market-based growth with tax-deferred earnings. It is a long-term retirement planning product with these important features. Your account will never lose value due to market declines. Your savings are protected from downside risk. So last year, there was over $24 billion invested in fixed indexed annuities across the United States. And, one of the primary reasons that people are, investing in these types of vehicles are for the primary purpose of a contractual guarantee of principal protection, meaning every dollar that you put into one of these vehicles, you can never lose a dollar due to market declines. Your investments plus any accrued interest over the time that you've owned it are completely safe from market downside risk. You can choose from several options for potential growth, one fixed interest option with a guaranteed rate, and additional options benchmarked to ETFs and an index. Any growth of your savings is tax deferred. It's another perk of an annuity. You pay taxes only when you make withdrawals or receive income in the future. At any time before maturity, you may add more premium to your account value, and you'll have full access to your account for unexpected healthcare costs, namely qualifying home health or nursing home care, or in the event of terminal illness. This benefit applies to conditions that arise 1 year or more after the contract begins. So right there in writing in the product brochure, addressing one of the number one misconceptions about an annuity is that you're tying up your money in retirement. And, should you have a rainy day event or a catastrophic health event that you need additional monies to pay for the cost of care, well, that misconception is just that. It states right here in writing that in the event you have an unexpected healthcare cost due to qualifying home health or nursing home care, or even terminal illness, you'll have full access to your account value, including any interest that you've accrued, even during the 10-year surrender period, which is your commitment to that contract for 10 years. So if anything happens within the first 10 years, you're 100% covered should you need the money for additional liquidity needs as they arise. From day one, you have a death benefit for peace of mind. That's another misconception that annuity companies keep your money if you pass away. Completely false. If you pass away, there's a designated death benefit that would go to your designated beneficiaries 100% without incurring any charges or hidden cost or fees. And in addition, it will avoid most oftentimes probate, which can be costly in its own right. You may withdraw your money at any time. Withdrawals in year 1 or withdrawals in years 2 through 10 of over 10% of your account value will incur withdrawal charges. So like most indexed annuities, they offer a free withdrawal during the first 10 years. In this particular product, you can access up to 10% of your account value anytime after the first year without incurring any withdrawal charges whatsoever. Okay, so let's talk about the growth potential. Your choice for tax-deferred growth. You choose any combination of these potential interest earning options. There is a fixed interest option, which they set the rate annually, and it's guaranteed to never be below 1%. Every year, you'll get a piece of communication from F&G that will let you know what that fixed interest rate option will be, and it will be guaranteed for that particular year. There are several options benchmarked to exchange-traded funds or ETFs. They are the iShares Core S&P 500, the iShares MSCI EAFE, the iShares US Real Estate, and the iShares Gold Trust, and an option benchmarked to the index, which is the CIBC Balanced Asset 10 Index. So with that being said, there's 5 different index options or exchange-traded fund options that we can allocate our monies to. And as you can see here, specifically speaking, the 4 iShare ETFs are very diversified. They're in completely different sectors. So in theory, you can diversify your monies within the product by allocating, whatever percentages you wish towards each individual ETF option itself. So if you had $100,000, since there are 4 iShare ETF options, you could put 25% or 25,000 to each one and have a very high level of diversification by doing that. We'll be looking at these specific ETF options and that indexed option as well to see how it would have performed over the last 10 and 15, 20-year periods. Each option is subject to participation rates and or spreads. We'll be covering what those terms mean. You are not investing directly in the index itself or the ETF. We protect you from downside market risk, and you're guaranteed not to lose any money due to market declines. At the end of each crediting period, any gains are locked in, and all the options may not be available in all states, so please check with your financial or insurance professional. So let's look at the key benefits here offered in the Power Accumulator 10 from F&G. The Power Accumulator 10 gives access for unexpected healthcare costs. If you need home health or nursing home care, or in the event of a terminal illness, you may access your total account value with no surrender charges or market value adjustments. The diagnosis of terminal illness or the beginning of home health or nursing home care must occur at least 1 year after the contract is issued. These are defined conditions, and this benefit may vary from state to state. The Power Accumulator 10 also offers a death benefit. Your account value is paid as a lump sum death benefit to the beneficiary you name in your contract. Now, you can name more than one. If you have 2, 3, 4, 5, 6, however many beneficiaries you wish, we can divvy them up and designate them to be the sole beneficiaries offered in this particular contract. You have the comfort of leaving a fund that your beneficiary will receive directly and have access to without delay. So if something were to happen to you, especially within the first 10-year period, your contract value and any interest that you've earned over that time frame would be passed to your beneficiaries 100%. And last but not least, the F&G Power Accumulator 10 offers a high level of peace of mind and the ability to withdraw. You may withdraw your money at any time. We know you may have unexpected opportunities or expenses. You'll have penalty-free access to 10% of the total account value in years 2 through 10. Any other withdrawals incur surrender charges and a market value adjustment. The surrender charge in contract year 1 is 12% of the withdrawal, and this percentage decreases each year over 10 years. The following states follow an alternate surrender charge schedule. I'm not going to read off those states, but if you do see them here, your surrender charge schedule will differ from the default surrender charge schedule. In these states, the surrender charge in contract year 1 is 9% of the withdrawal, and this percentage decreases over 10 years. So with the market value adjustment, anytime a withdrawal incurs a surrender charge, a market value adjustment will be made. The market value adjustment is based on a formula that takes into account changes in the U.S. Treasury yields since the contract was issued. Generally, if Treasury yields have risen, the market value adjustment will decrease the surrender value. If they have fallen, the market value adjustment will increase the surrender value. The market value adjustment does not apply in the following states. And annuitization. So every annuity offered on the marketplace today has the ability to do what's called annuitization. And we'll dive into that just momentarily. You don't have to worry about outliving your assets. You can turn your annuity into scheduled income payments for life on its maturity date. The maturity date of your F&G Power Accumulator 10 annuity is set when it is issued. So annuitization is the original form of lifetime income or period certain income using an annuity. So the word annuity, if you look up the definition of annuity, it's a series of payments or sometimes a lifetime of payments. And the oldest traditional way of an annuity was an exchange for value. Okay, the person issuing the annuity, whether it be a person, hundreds of thousands or thousands of years ago or hundreds of years ago, since annuities have been around since the Roman ages, the person would guarantee a stream of income in exchange for that value. Now, value back then was, goods and services, and it wasn't just money. But in today's day and age, annuitization is basically the terminology used to describe an exchange for the contract value or the actual investment in the annuity. The issuing insurance company will guarantee a stream of income payments, whether it be for life or for a period of time. And every annuity has the ability to convert to an income stream. So just because the Power Accumulator 10 is what we call an accumulation focused annuity, it doesn't mean that you can't convert the contract value to an income stream if you so choose or wished to do that. You would have the ability to do that, and those terms are set when the annuity is issued. So in the annuity policy itself, there will be an annuitization page, and it will describe the terms and conditions of annuitization if you were to choose that route down the road. Now, it's completely optional. It is not mandatory. So just keep that in mind. I think there's a stat that less than 3% of all annuities sold today ever annuitize. So it's very rarely ever executed, simply because there's other features today called a lifetime income rider that can give you the same exact concept without giving up control over the asset inside the annuity. Okay, tax information. The annuity is tax deferred, which means you don't pay taxes on the interest as it's earned, only when you withdraw it. Tax deferral may not be available if the annuity owner is an entity such as a business. Withdrawals are treated as coming from earnings first, which are taxable, and then as a return of your premium. If you withdraw money before age 59 and a half, you may also pay a 10% penalty to the IRS. Please keep in mind that buying an annuity in an IRA or other tax-qualified retirement account offers no additional tax benefit since the retirement account is already tax deferred. If your annuity contract is within a tax-qualified plan, you may be required to take minimum distributions beginning at age 72. You may exchange one tax-deferred annuity for another without paying tax on the earnings when you make the exchange. Before you do, compare the benefits, features, and cost of the two annuities. You may pay a surrender charge on the annuity you are exchanging, and you may start a new surrender charge period with the new annuity. F&G does not offer tax or legal advice. Consult a properly licensed tax professional regarding your specific situation. Okay, so that's going to go ahead and wrap up the brochure. So now we're going to go ahead and dive in to the software portion of our review, where we're going to be taking a look at the hypothetical backtest to see how these index crediting strategies would have potentially performed if we owned them over the last 10, 15, and 20-year periods. So just bear with me. I'm going to go ahead and share my screen again. Before we dive in, if you're getting some value out of this annuity, it would be greatly appreciated if you could give us a thumbs up and possibly share this video with any friends or family that you feel may get some value out of this as well. And if you'd also like to work with me directly, you can visit our website at AnnuityAssociation.com. Right there on the main page, click the green button to request your free report and fill out the series of questions. And if you'd like to be contacted by me directly, simply answer yes to the question if you'd like to be contacted, of course, and I will reach out to you in a timely fashion to see how I can help point you in the right direction. Okay, so let's go ahead and dive in here. Let me go ahead and share my screen again. Just bear with me. Okay. All right, here it comes. Thanks for your patience. It seems the system is running a little slow. Okay. Here we go. All right, let me go ahead and share this again. Okay, so what we are doing here is in our software that we use at Annuity Association, we're able to compare every single independent fixed indexed annuity offered today on the marketplace and take a look at every individual index crediting strategy that's offered in the particular products, and then back test them over the last 10, 15, and 20-year periods to help give us an understanding of, how these products could have potentially performed if we own them during this time. Now, again, must make the disclaimer that, prior performance is not always the best indicator for future performance, but I really feel it does give us a level of, thought in terms of, what these could potentially do if markets were to repeat themselves, in essence. So what we're doing here is listed in chronological order for the Power Accumulator 10 is going to show us the top performing index strategies that are offered within this particular product. Now, in this particular product, there are going to be a series of different index crediting options that will include what's called an enhancement rider, which is basically a fee that is charged to essentially buy us more participation rate of the underlying index to, in theory, give us higher opportunity for growth during the positive performance years for that specific underlying index. So I'll explain here in just a moment. So coming in number one in the Power Accumulator 10 is the 2-year point-to-point with a participation rate for the CIBC Balanced Asset 5 Index. This index here is utilizing the 1.25%, what we call a performance enhancement rider. Now, I will explain in just a brief moment what that exactly means. So when we look at the crediting strategies offered in an indexed annuity, we have to understand how the index and how the credit is occurring. So when you look at the performance of the underlying index, there is a thing called a participation rate. And the participation rate is used as part of the formula to determine what the net credit will be to the annuity account contract value. So in this case, when we add the performance enhancement rider fee of 1.25%, we're actually increasing the participation rate on this particular crediting strategy to 170%. So let me explain this. If during this 2-year point-to-point, the Balanced Asset 5 Index had a positive growth or positive performance of 10%, the annuity company will take that 10% growth and then multiply it by 170%, which is the participation rate, and then that will equal your net credit before the account fee is subtracted. So your net fee would obviously have an account fee that's subtracted against the contract value. However, to get the actual interest credit, you're going to take the performance. In this case, let's say it's 10%, multiply it by 170% participation, and the interest credit that would be given to the contract would be 17%. So that's a basic rough way of understanding what a participation rate is, as well as an enhancement rider that's going to increase the participation. Now, let me show you, before we go through every other index option here, let me go ahead and show you if we were to take off the account fee, which is that performance enhancement rider. We'll notice that the Balanced Asset 5, the same 2-year point-to-point, drops from 170% participation to 130% participation. So a significant difference, 40% difference in participation when we take off or remove that performance enhancement rider. So the rider is completely optional. You don't have to get it, but obviously there is some value in considering it, given the fact that, when we do add it, when we do our back testing exercise, that particular index comes in number 1. But when we remove it, that index strategy, the 2-year point-to-point Balanced Asset 5, now becomes number 3 on the list without the fee. Okay, so let's go ahead and take that filter back off. So when we look at the top performing index strategy here, it's the 2-year Balanced Asset 5 point-to-point using a participation rate with the enhanced participation. And we'll look at the 10-year performance coming in at 9.53% average annualized rate of return over that 10-year period from December 31st of 2010 to December 31st of 2020. Now, you'll see a green and red number just below that. And in addition to understanding what the average rate of return was over the last 10 years, hypothetically, we're also able to determine over the last 20-year periods what the highest 10-year performance was over the last 20 years and what the lowest 10-year performance was over the last 20 years. And so this green number is indicating the best 10-year performance looking back over the last 20-year period. And that so happens to be from December 30th of 2009 to December 30th of 2019, with an average annualized rate of return of 9.96%. And then the red number to the right is still a positive number, just red indicating the worst 10-year performance happens to be from December 30th of 2003 to December 30th of 2013. And that was a 5.54% average rate of return during that 10-year period. Now, I think that's a very important data set to consider. And when I'm advising clients, my philosophy is, don't make the decision on the annuity based on the best case scenario. Make the decision on the worst case scenario. And in this case, when we look at this backtesting exercise, we can identify a very difficult time in our economy where we were facing some very negative performing markets. In this case, we were coming right out of the dot-com bubble bust, which was 2000, 2001, 2002. So this period is coming from 2003 and then going through 2013, which, if you remember, 2007, 2008, another black swan event occurred where the global financial crisis hit. And, we had another very bad series of market returns for a significant period of time. So taking us through a very difficult, stressed time, this 10-year period specifically, and still coming out with a 5.54% average rate of return, if we own the product during this time frame, is very, I think it's very positive. It tells a great story. And when you're considering your annuity, make the decision on the worst case scenario. So if you can sleep at night knowing, hey, during some of the worst financial times in our history, I still would have averaged 5.54% a year, hypothetically, in this exercise, of course, then, maybe it's a product you should consider. So good food for thought there. Okay, over the last 15 years, we'll see an average rate of return using the same specific index strategy of 6.61%. Coming in number 2 is the 1-year balanced asset 5 point-to-point with a participation rate, again, using the performance enhancement rider of 1.25% fee and the participation rate of 145%. So we'll see the average 10-year annualized rate of return, 9.43%, highest 10-year period at 9.76, and lowest 10-year period at 5.32. And then coming through to the 15-year period from December 31st of 2005 to December 31st of 2020, 7.27%. And then number 3, again, is the Power Accumulator, this time the 7-year product. There is a 7-year version and a 10-year version. Their number 1 in the 7-year product is, again, the 2-year balanced asset 5 point-to-point with a participation rate using the performance enhancement rider of 1.25% fee, and the participation rate's 165% on that product. And you'll see 9.27% coming in average over the last 10 years, 9.68 with the highest 10, and 5.38 with the lowest 10. 6.43 over the last 15. All right, and then moving on, there is another way to use the Balanced Asset 10 index. This time it's the Balanced Asset 10 index, a little bit different design in this particular index, but still offered by CIBC. This is the 2-year Balanced Asset 10 participation rate with a spread. So instead of a performance enhancement rider, this one has no rider, so there's no fee. There's 100% participation with a 5% spread. Okay, so let's break that down. What is a spread? I refer to a spread as a haircut. Okay, let me explain. Since there's 100% participation, that means you would get 100% to participate in 100% of the index's performance. So again, let's use the example that during the 2-year point-to-point period, if the index went up 10% or had 10% positive growth, then you would multiply the 10% by 100% participation, and that would equal 10%, right? Well, because there's a 5% spread, a 5% spread is a haircut off the top of that gross 10% number. So here's how it would work. If the index went up 10%, you multiply it by 100% participation. That equals a 10% gross credit. Then you multiply it by the 5% spread, or subtract the 5% spread, and then your net interest credit that you would receive as the owner of the annuity would be 5%. So the spread is a haircut. It's like a rake in a casino. You don't keep all the pot, the casino keeps some. That's exactly how a spread works. Okay. So we'll take a couple more looks here. Let's go ahead and move on down to the iShares just to see how those perform. So we have the 2-year iShares Core S&P 500 point-to-point with a participation rate and spread. We have a 56% participation rate at the time of this review with a 5% spread. And we will see the average 10-year annualized performance at 5.36%. That also happens to be the highest 10-year performance. And then the lowest 10-year performance at 1.61. The average annualized rate of return over the last 15 at 3.81 and over the last 20 at 4.76. We'll take a look again at the iShares Core S&P 500 just using a participation rate with no spread. We'll see a 29% participation, 3.68% average rate of return, 3.45% over the last 15, and 3.15 over the last 20. The iShares MSCI EAFE using a 30% participation in a 1-year point-to-point, 2.23% over the last 10, 4.06 in the highest 10, and 1.93 in the lowest 10, 2.58 over the last 15. We have the Gold Trust, iShares Gold Trust, 1-year point-to-point with participation, 27% participation rate, 2.14% over the last 10, 3.31 highest 10, 2.14 lowest 10, and 3.34 over the last 15. And then the U.S. real estate using the 62% participation with a 5% spread. This is the 2-year point-to-point, and it's 1.95 over the last 10, 8.09 highest 10, 1.95 lowest 10, and 2.07 over the last 15, and 4.64 over the last 20. So that's going to cover all of the index strategies. If you'd like to compare these more in depth, again, I'd be honored to work with you directly. Or maybe you want to compare this annuity to another one on the market that you already own or that you're thinking about buying. If you'd like to work with me, I work with clients in all 50 states using Zoom. You can visit my website at AnnuityAssociation.com right there on the main page. Click the green button to request your free report, and I will reach out to you in a timely fashion. Okay, so the last thing to do here, and then we will be wrapping up, is to take a look at an example illustration using this product here, the GPowerAccumulator 10 offered by F&G. So we're going to take a look at a $100,000 initial contribution, a male 60 years old in the state of Florida using non-qualified monies. And we're going to see how this thing will look on a ledger. Okay, so we're going to select the top index strategy using our back testing, which happens to be the 2-year point-to-point balanced asset 5 with the participation rate and enhanced rider. And we'll take a look and see how it performs. Okay, so let's go ahead and look at the current rates. So here you see year one, $100,000 going in. And then because there is that performance enhancement rider, you'll notice the account value at the end of year one brings that premium down to $98,750 to cover the fee. But as soon as the performance of the index, underlying index actually occurs at the end of the 2 years, since this is a 2-year point-to-point, the interest is credited at the end of the second year. You'll see 20.39% being credited to the account value, bringing that account value back up to $118,885 at the end of contract year 2. You'll notice the death benefit to the far right will always equal the account value. So even during the 10-year surrender period, if something were to happen to you, the death benefit will always match the contract value or account value, which includes the interest that you've locked in during that time frame, and those monies would be passed on to your designated beneficiaries and avoid probate. So you'll notice because we're using a 2-year point-to-point strategy, every 2 years we have the opportunity to have an interest credit applied. And so any years that you see 0, that's just the first year of that second crediting period, the first year of the 2-year crediting period. Excuse me. Okay, so we'll see year 4, 37% was credited to the contract. At the end of year 6, 2.72. At the end of year 8, 13.99. And then at the end of year 10, 28.47. Now, what this example illustration is doing is we're looking back over the last 10-year period to see how this index strategy would have performed, and then we're applying it to this illustration to show you how the account value would have grown over the last 10 years if we own that product during this time frame. So you'll see at the end of contract year 10, when this person is approaching age 70, the $100,000 would have grown to $233,321 with zero downside risk to market declines. So hope this explains how this product works. And if you'd like to take a deeper dive and comparing this product to, again, one that you own or one that you're thinking about buying, I'd be honored to have that opportunity and would appreciate to definitely work with you and help point you in the right direction. If you'd like to do that, you can go to our website at AnnuityAssociation.com. Right there on the main page, click the green button to request your report, and you'll be taken to a series of opt-in questions. One of those being, would you like to be contacted by an advisor? Simply answer yes and leave your phone number, of course, and I will reach out to you in a timely fashion to see how I can help point you in the right direction. So if you've gotten some value out of this annuity review today, please give us a thumbs up, share it, like it, and hopefully some other people out there can get this information that they're potentially looking for to help them make an educated decision. We would be greatly appreciative of that as well. So thanks so much for tuning in. Hope everybody has a great day out there. Take care of one another. This is Jeremiah Conger from Annuity Association signing off. Have a great day. Thank you.